All right, let's pull back the curtain on one of the most confusing documents you'll probably ever sign, your health insurance policy. We're going to get right into it.
You know that feeling, right? You open up your policy and it's just pages and pages of dense text. It almost feels like it's written in another language, just designed to be impossible to understand. But what if I told you that's not actually the case?
See, that document isn't a mystery novel. It's a contract. And like any contract, it follows a very specific set of rules. There's a hidden structure in there, and once you see it, everything starts to click. So today, we're handing you the official rule book.
So how in the world do we decode this thing? Well, it turns out there's a standardized model, a kind of template, that almost every state has adopted to bring some order to the chaos. And that model is our key to understanding everything that comes next.
This is basically the decoder ring. It's called the NAIC Model Provisions. The National Association of Insurance Commissioners, or NAIC for short, created this model law to make sure the language in health policies is consistent and fair. It means that no matter who your insurer is, the basic rules of the game are surprisingly similar.
And here's the best part. The NAIC model splits all those complicated rules into just two simple categories. First, you've got mandatory provisions. These are the rules that must be in your policy to protect you. And second, there are optional provisions which the insurance company may include to protect themselves. Let's start with the ones that have your back.
Okay, so these are the mandatory rules. Think of them as your Bill of Rights as a policyholder. Every single individual policy has to include them. They are completely non-negotiable.
First one up is the entire contract clause. And the easiest way to remember this is just what you see is what you get. This rule is simple. The only legally binding parts of your agreement are the policy document itself and your signed application. That's it. So if a salesperson promised you something, or you saw a cool brochure, doesn't matter. If it's not in the written contract, it doesn't count.
Now this next one is absolutely crucial. It's basically a statute of limitations for your policy. Once your policy has been active for a certain amount of time, the insurance company can't just turn around and cancel your coverage because of a mistake you might have made on your application. The only, and I mean only exception here is if you committed outright fraud.
So how long is that period? Well, the official NAIC model sets that time limit at 3 years. Now, some states have actually made it even better for you and reduced it to 2 years. But the national standard, the blueprint, is 3. After that time passes, you are in the clear.
Look, life happens. Sometimes a payment gets missed. The grace period is your safety net. It's a mandatory buffer, a little extra time after your premium is due that lets you pay up without your policy getting canceled on the spot.
And how long that grace period is depends on how often you pay. So if you're paying weekly, you get 7 days. If you pay monthly, which is what most of us do, you get 10 days. And for any other schedule, like paying quarterly or annually, you get a full 31 days.
Okay, but what happens if you have a dispute over a claim and you feel like you need to take legal action? Well, there are rules for that too. You can't just sue them the next day, but you also don't have forever to make a move. This provision sets a really clear timeline.
And this timeline is a two-parter. It's super important. First, you have to give the insurer at least 60 days to investigate your claim after you've submitted all your proof. That's the waiting period. After those 60 days are up, the clock starts ticking for you, and you have a maximum of 3 years to file a lawsuit if you need to.
All right, we've covered your protections. Now let's flip the coin and look at the other side, the optional provisions. These are the rules the insurer can choose to include to protect their own interests. This first one, it makes a lot of sense when you think about it. Your job has a direct impact on your risk of getting sick or injured. So, if this provision is in your policy and you switch careers to something more or less hazardous, the insurer has the right to adjust your coverage to match that new risk level.
So here's exactly how that works. Let's say you move to a more dangerous job. You go from being an office worker to, a hang gliding instructor. Your premium actually stays the same, but your benefits get reduced to match that higher risk. But on the flip side, if you were a police officer and now you're a librarian, your benefits stay the same, but your premium will actually go down. Fair is fair.
Oh, this is a really common one. Let's say you just made an honest mistake. You put down the wrong age when you applied. Does the insurance company just get to cancel your policy? No way. There's a specific rule for exactly this scenario. So, this provision, the misstatement of age rule, allows the insurer to adjust your benefits to what your premium would have bought at your correct age. So, for example, if you said you were 25 but were actually 30 and your premium got you a $500 monthly benefit, well, the insurer will just adjust it down to, say, $400 a month, which is the amount that premium would have purchased for a 30-year-old. They fix the math, they don't void the policy.
Hey, remember that grace period we talked about? This rule is directly connected to it. Let's say you have a claim during your grace period, but you haven't paid that month's premium yet. The insurer can simply subtract the premium you owe them directly from the benefit check they send you. It's a really straightforward way for them to collect what's due without any hassle.
So, after all of that, what's the big takeaway here? Well, it all boils down to this. Knowledge is power. Your health insurance policy isn't some mysterious black box full of secrets. It's a structured document with rules that you can actually learn and understand.
So let's lock this in. The crucial things to remember are: your policy is a structured contract, not a mystery. It's built on two pillars: mandatory provisions that protect your rights and optional provisions that define the insurer's rights. Understanding that simple divide is the key. It's how you know where you stand, and that's how you take back control.
So I'll just leave you with this question. Now that you have the rulebook, now that you know there's a predictable logic behind all that fine print, will you feel a little more confident picking up your own policy and seeing what it really says?